I think the whole thing predicates on the minute that Bitcoin got above 100,000. That was in December 6th. That's the first end of the day that it closed above 100,000. That was the catalyst, I think, for gold to take off. Since that day, gold's up about 30%. Bitcoin's 104 at the moment, so it's basically at the same level.
Yeah.
The stock market's flat. So to me, what it's telling us is Bitcoin sees an end game for risk assets in the U.S. Gold sees that. Bitcoin's the peak at 100,000. I think gold's going to continue to rally, and Bitcoin's the leading indicator for everything. So I suspect it's telling us with the Bitcoin gold ratio that U.S. stock market's going to tilt lower, and if it doesn't, then gold will be one of the key things to suffer. So I'm still quite bullish gold.
Gold remained range-bound on Monday, reflecting investor caution amid rising geopolitical risks and renewed uncertainty over the Federal Reserve's rate outlook. The metal hovered near $3,369 an ounce in subdued trading, with U.S. markets closed for a public holiday. Market participants continued to assess the implications of escalating tensions in the Middle East, alongside the Fed's recent inflation warning, which has tempered expectations for aggressive monetary easing in the near term. MikeMcGlone, senior macro strategist at Bloomberg Intelligence, notes that gold's trading range between $3,000 and $3,500 reflects deep market uncertainty. A decisive break above $3,500 could signal broader global trouble, such as a weakening dollar, increased market volatility, or a downturn in equities. On the other hand, a drop below $3,000 might indicate economic recovery, although McGlone views this scenario as unlikely in the current macroeconomic environment. Despite bullish sentiment surrounding gold's nearly 30% rally this year, some caution has emerged. Analysts at Citigroup recently cut their year-end gold price forecast, warning that prices could fall below $3,000. Their view is shaped by expectations that the Federal Reserve will eventually cut rates to support economic growth, which could reduce gold's appeal as a haven. Still, gold continues to find support from a softening U.S. dollar, which has pulled back from recent highs. McGlone argues that gold's resilience in this environment suggests markets may be anticipating a correction in equities. While some analysts expect stocks to post another 10% gain, persistently high interest rates and stretched valuations could put pressure on risk assets. Bitcoin, meanwhile, has touched the $100,000 mark but has since stalled. While gold's steady climb has brought the Bitcoin to gold ratio down to 31st, McGlone suggests this could indicate Bitcoin has peaked in the near term, with gold now reclaiming leadership as the more stable store of value. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I think it's the pause before the next leg up, and it's got to make it difficult. 3,000 is good support, 3,500 is good resistance. By the time this hits the tape, I'll be out with my metals outlook for the second half, and I'm just nailing down what I think matters for gold. Gold below 3,000 is a wonderful thing. I think it's unlikely because it means the rest of the world's tilting over towards the U.S. stock market going up, the dollar's stronger, and the rest of the world's recovering. Gold above 3,500 is a bad thing for the rest of the world, but I think that's what's going to happen, and that indicates that what's happening now will accelerate, meaning the dollar's going down, potentially with the U.S. stock market going down, volatility going up, and the world tilting towards deflation. To me, that's the more likely scenario. The thing is, I'll say right now, is if the expectation is you can't say gold anymore without talking about the stock market and or Bitcoin.
Yeah.
And so I'll point out what I think the key relationship is right now. Gold's right now priced for the stock market to potentially be down in the year. Yet the estimates are it's going to be another 10% year. So I'm sticking with gold. I think the number one pressure factor for gold will be if the stock market continues to rally, interest rates stay strong, and maybe we get a little detente in, say, most notably Middle East or Russia and Ukraine. But
yeah.
So this to me is part of what gold's front running. The key thing is also look at gold Bitcoin. Mm-hmm. That cross is like about 31 right now. It's 31 ounces of gold per one Bitcoin. It's been stuck at that level since 2021, and it used to have a very high correlation with the stock market beta. Yet it's telling me, I think it's telling us that it's ready to tilt lower. And I think the whole thing predicates on the minute that Bitcoin got above 100,000. That was in December 6th. That's the first end of the day that it closed above 100,000. That was the catalyst, I think, for gold to take off. Since that day, gold's up about 30%. Bitcoin's 104 at the moment, so it's basically at the same level.
Yeah.
The stock market's flat. So to me, what it's telling us is Bitcoin sees an end game for risk assets in the U.S. Gold sees that. Bitcoin's the peak at 100,000, I think gold's going to continue to rally, and Bitcoin's the leading indicator for everything. So I suspect it's telling us with the Bitcoin gold ratio that U.S. stock market's going to tilt lower, and if it doesn't, then gold will be one of the key things to suffer. So I'm still quite bullish gold. I think it breaks above 3,500 an ounce, but it's also, that's very disconcerting. That'd be up a third on the year, and there's only a handful of years in the last 100 years that we've been up that much. Most of them were inflation in the 70s, and there was one in 1934. We came off the gold standard, and then around 2020, then some of the great recession. Both gold ETFs and Bitcoin ETFs. The significance, I think, is in gold. Gold has had 4 years in a row of outflows in ETFs. Now this year's kicked into inflows pretty significantly, the most since 2020 so far. It's on pace to match what happened in 2020. Remember, that was the biggest money pump in history. The difference, so I think now it's happening with Bitcoin is gold is a risk-off asset, and Bitcoin is a very much risk-on asset. And the most people are buying Bitcoin are buying into the mantra that they will be protected from debasement of the U.S. dollar and inflation. Mm-hmm. They're trading the last big trade. That trade was ripe to do the last, I don't know, maybe 5-6 years, particularly in 2020 when Michael Saylor discovered Bitcoin when it was 10,000 and got way bullish. But at 100,000, we have a pile-on situation going on. I'm really concerned. And there's also unlimited competitors in that space. People say Bitcoin supply is limited. Yeah, I get it. 21 million Bitcoins, but there's 17 million cryptocurrencies. That's just silly. And you look over at gold, there's 4 precious metals: gold, silver, platinum, palladium. Silver's catching up, platinum's catching up, and they're all catching up because there's only one foul. And there's 4 of them. So I look at the whole space as cryptocurrencies led the way up. Bitcoin was the first in 2009. Now there's 17 million of them. And I think they're going to lead the way down. And I mentioned that earlier. On the year, the Bloomberg Galaxy Crypto Index is down 14%. It has a very high correlation with the stock market, despite the fact the stock market's up slightly. What happens when the stock market goes down? I think that's what's happening already. Stock market goes down, all this cryptos decline hard, and gold continues to rally. Now, if I'm wrong, that'll be a pressure factor for gold, and cryptos should lead the way up. And so far, I think this 100,000 level in Bitcoin marks the threshold akin to 5,000 in NASDAQ in 2000. And sometimes you're just supposed to be selling when they're yelling. Silver just broke above significant resistance at 3,500. That silver-gold ratio, when it reached 105 just like a month ago, was just a signal it's never ended the year above 100. I mean, so now we're back down around 90, silver to gold, 92 actually. And I still favor, to me, the key thing to remember, silver is known as a devil's metal for a reason. It trades 2 times the volatility. And on the year, it's up 25%, gold's up 28%. On a 1-year basis, it's up 22%, and gold's at 44%, yet silver has double the volatility. So on a 1-year basis, silver should be up 80%. It's just catching up, and I think that's a key thing. It's just catch up to gold. Gold's the leader, and if gold continues to lead, these other precious metals will just play a little more catch up.
Massive government deficit spending, currently around 6 to 7% of GDP, is one of the key reasons the U.S. stock market and economy have continued to show resilience, according to MikeMcGlone. However, he warns that such spending is not sustainable. Without corresponding economic growth, persistent deficits could turn into a serious long-term drag on the economy. This concern is echoed in the latest dynamic analysis from the Congressional Budget Office, which found that the House-passed version of the One Big Beautiful Bill would increase federal budget deficits by a staggering $2.77 trillion over the next decade. That's $300 billion more than the CBO's earlier estimate, which projected a $2.4 trillion deficit increase using conventional scoring. The projected deficit is primarily the result of revenue reductions totaling more than $3.5 trillion, driven mainly by tax cuts, which far exceed the estimated $774 billion in spending reductions. While the CBO expects some positive economic impact, specifically an $85 billion reduction in primary budget deficits due to increased output, these gains are offset by rising interest payments, which are projected to add another $441 billion to federal debt servicing costs over the same period. In McGlone's view, if deficit spending continues at this pace without fundamental structural reforms or productivity gains, markets could face mounting pressure, potentially destabilizing asset valuations and accelerating the flight to safe haven investments, such as gold. Let's get back to the interview.
So the key thing, that's one thing, I think one of the main things that's supporting the entire U.S. economy and the U.S. stock market is the deficit spending, 6-7% GDP. Now we've addressed that a little bit with Doge, and it's top of the headline now, which usually means it's the end of it. But the key thing also is, yes, if we do have this package and it does kick in this continued